All right, I want to go ahead and welcome everybody to the Lumberyard Podcast. Once again, I am excited to have Cody Daniels, founder of Builders Tax Group, with us once again. And this is going to be part 3, and we're going to keep continuing on for our series that we're doing, really talking about the book of A Contractor's Guide to Strategic Tax Savings. Again, this is his ebook detailing 10 strategies to minimize taxes for contractors, and that is available for free download. Before we get started into the episode, I want to just again give a introduction of him. So Cody Daniels, CPA with over a decade of experience. He led the construction and real estate tax team for a top 150 CPA firm. Again, he founded the Builders Tax Group in 2024, specializing in tax strategies for construction service trade businesses. And his true mission is just to help contractors run more profitable businesses through strategic tax planning, outsourced accounting, and fractional CFO services. So Cody, welcome to the show once again.
Jennifer, thanks for having me back, and thank you for the great intro there. The first 2 conversations we had were fantastic, and I know we're set to have another great conversation today.
Absolutely. So tell me, what do you have in store for us today? What is the outline?
Yeah, so we're going to wrap up the final 4 chapters in the ebook here. So our first strategy today is just confirming that losses and deductions are not going to be limited for tax purposes. The second strategy will be just focusing on state and local taxes as a meaningful part of your tax liability. Obviously, federal taxes get the bulk of the focus, but state and local taxes can have a real meaningful impact on your tax liability as well. And then we'll round things out with estate and gift planning, which I think is a frequently overlooked part of tax planning for most small business owners. And then the last chapter in the book is more of a mindset type chapter. It's not, kind of hard strategy like the other chapters, but it's just, preparing for upcoming tax law changes. We recently had the One Big Beautiful Bill Act that was passed at the beginning of July. And so just, helping contractors, small business owners sort of like adopt a mindset around just staying up to date and being aware of the evolution of tax law and things that impact their business. Obviously, not expecting anybody to become an expert in these things, but just taking a proactive approach to running your business and being aware of opportunities that exist for you out there.
So basically, you're telling us 4 strategic moves contractors should make before year end to avoid surprises and keep more money in their pockets.
Always before year end. We can do a lot of good for you if you get a hold of us early. After the end of the year, we're pretty limited. There's still a few levers that we can pull, but always preach a proactive approach to tax planning and just overall operations of your business.
All right, perfect. Well, let's just jump into strategy 1. So that's going to be confirming losses and deductions are not limited. Can you dive more into this for us?
Yeah, so I think, there's a bit of a misconception around tax planning that we're always trying to drive our taxable income to the lowest amount possible. And that's not always the case. There's going to be instances where, we may want to show some taxable income because we have expiring credits or expiring net operating loss deductions, things like that. But in instances where we are able to generate losses for tax purposes, we want to be aware of whether or not we're going to actually receive those benefits in the current year, because there are numerous provisions within the tax law that prevent the utilization of losses in the current year and cause those losses to be suspended and carry forward to future tax years.
So are you this is talk more about like the loss limitation funnel.
Yeah, so I like to visualize this as a funnel. There's sort of a series of provisions within the tax law that can cause losses to get hung up, so to speak. And you really have to work your way through the entirety of the funnel to confirm that you're going to get a partial or full benefit of the losses. So at the top of the funnel, we have basis limitations. And I don't want to get too into the weeds on this because how basis is determined varies by entity type. So there's a little bit of nuance in there. If you're a partnership versus a S corporation versus a sole proprietorship, there may be different ways that you calculate your basis there, but effectively, what the basis limitations say is that you can't deduct losses beyond your investment into your business. So that would include, your contributions into the business, cumulative retained profits in the business, and then certain business debts can increase your basis as well. So that's sort of level one of the funnel.
Okay.
Moving below that, we have at-risk limitations. And really the difference there is that certain debts are not going to provide you with at-risk basis, so to speak. So again, it's just a little bit of a nuance there where we're going to exclude certain liabilities from that calculation. So assuming that, you have sufficient basis and you're at risk for your investment in the business, we're going to move down to the next step, which is passive activity losses. So for most entrepreneurs, their core business, they're going to be considered non-passive or active in that business. But for other, maybe like side businesses, for example, maybe you have an investment in like a rental real estate or something like that on the side, or even, I guess, other operating businesses. Maybe you're a minority investor in a restaurant or a bar or something like that. That activity may be considered passive. So you may not be able to utilize those losses against your non-passive business income. So your rental loss may not be available to offset the income that you're generating through your construction business.
Okay.
Going a step further, we have this concept of excess business loss limitation. This is still in effect and actually was made permanent by the One Big Beautiful Bill Act. This came about during the first Trump presidency as part of the Tax Cuts and Jobs Act. Effectively, here there's a calculation. Don't need to get into the weeds on how it's calculated, but you can only use up to a certain amount of losses from your businesses to offset other sources of income. So like wages, for example. So if, you have a spouse that's earning wages from a job and you're the business owner, your losses from that business may not be able to fully offset your spouse's wage income.
Okay.
And then I would say kind of the bottom of the funnel, if you're able to get through all of those steps and you're still able to deduct your losses, for lack of a better term, there's a limitation for net operating losses. Again, this was put into place during the first Trump administration with the Tax Cuts and Jobs Act. So net operating losses can only offset up to 80% of your taxable income. So even if you do generate a loss from your business in a year, and there's a lot of ways you can generate losses, right? It could be accelerated depreciation. It could be like we discussed, I think back in episode 1, using certain deferral methods available to contractors. If you're using the completed contract method, you may be cash flowing because you're receiving cash. But if you haven't finished the job, you're deferring the gross profit recognition on that job for tax purposes to a future tax year. You might still be experiencing a loss. So there's a lot of ways you can create losses for tax purposes. All that's to say, next year, when you go to deduct that net operating loss, you can only deduct it up to 20% of your or up to 80% of your taxable income. So you're still stuck paying taxes on 20% of your income. So again, very nuanced, part of tax law, but I think it's just important for business owners to recognize that just because you've generated a loss doesn't mean you're going to get the full benefit of that loss in this tax year. And, it's worth a conversation to, see how you should maybe plan around that. So I think one good example of that is, with my clients, really every year we have a conversation towards the end of the year. Should I go out and invest in fixed assets for the business? Everybody knows that investing in fixed assets is going to trigger accelerated tax depreciation. We have 100% bonus now, thanks to the One Big Beautiful Bill Act.
Okay.
So if they go out, in most construction vehicles are going to qualify for full write-off, really all construction equipment and machinery, things like that. So I think you need to look at, well, okay, yeah, if I generate a loss through this accelerated depreciation, am I going to get the benefit of it? And if you're not, maybe you think about postponing those purchases to the next tax year. So I think, understanding whether or not you're going to get these benefits can help you make decisions around, non-tax parts of your business. Again, whether you should buy equipment, whether you should have like a cost segregation study done on your real estate. If you're not going to get the benefits of a cost segregation study, why incur those costs to have that study done?
Correct. So at the end of the day, I mean, really emphasizing you need to get with a tax professional before year end to see if those losses are actually going to benefit you.
Absolutely.
Okay, beautiful. Anything else you want to say on that strategy before going to the next one?
No, I mean, I think, again, you hit the nail on the head getting with your tax pro before year end.
Yeah.
I think, I guess maybe the one thing I would add is, this particular strategy really ties into a lot of the things that we've discussed previously. Like it ties into entity structure. Like I said, if you're an S corporation versus a partnership, the way you calculate these limitations is going to be different. It ties into decisions around bonus depreciation. Your method of accounting is going to have a big impact on, how you're able to generate losses for tax purposes. So it's really kind of the culmination, or I guess a result of the other strategies that we've considered implementing throughout this series.
Okay, perfect. Well, let's go ahead and go to the second strategy. Don't forget about your state and local taxes. So dive right in.
Yeah, so a couple things here. I mean, we have the multi-state component of this, where if you're a contractor going over state lines, there's issues that go along with that. But I think, if you're a contractor that's operating within your home state and you never leave the state, there's issues that you need to be aware of there as well. So I think I'll start with, kind of the multi-state experience and some of the challenges that can come along with that. If you're a contractor that crosses the border into another state, there's obviously the income tax implication of that, but there's a whole other suite of tax issues that could impact your business. You have potentially sales and use tax issues, depending on the frequency and, just sort of your employment base. You could have payroll tax issues. So it's not just the income tax implications of that. And I would say that as a construction business, it's really hard to stay off of State Department of Revenue's radar when you move into a new state and start doing jobs up there. Number one, I mean, you're likely pulling permits. And so that in and of itself is typically going to require some form of registration with the state or, municipality, county, whatever it may be, in that new state. So that alone is going to put you on their radar.
Yeah.
But I've heard stories even beyond something like that, where auditors for state departments of revenue, they may be driving to the office or they may be out to lunch, and they drive past a job site and they see on the truck or the van, big decal, ABC Construction, right? They can go into the office and they can drop your name in their database and determine if you've been filing with them. And I've heard that it's not out of question for an auditor to open up an audit on a contractor simply because they saw them doing work in the state and they got their name, plastered in big text on the side of their vehicle. So, this is an industry where it's really hard to avoid getting caught at some point in time if you're, crossing state lines. And the big downside to this is there's no statute of limitations if you're not filing. So typically for tax purposes, you file your return. Either the IRS or the State Department of Revenue has 3 years from the filing of that return to go back and audit it and, propose adjustments, et cetera. if you've been doing work in a state for a number of years and
Mhm.
you haven't been filing, there is no statute of limitations. So they can go back in time. I worked with, I'm located near Chicago. So a lot of my
Yeah.
clients are Illinois based. I worked with an Illinois based contractor that started going up into Wisconsin, just over the border, doing jobs pretty infrequently a few years back. And they were identified by the state of Wisconsin for a sales and use tax audit. So this is not income tax; it's sales
Mhm.
and use tax. So what Wisconsin was attempting to gather from this contractor was use tax on materials that were purchased in Illinois, but used at job sites in Wisconsin. And so we had to go back and effectively self assess late sales and use tax filings for this contractor. Go back in the records, identify the materials purchases and what job sites they were used at. And I think we ended up settling with the state to file and pay taxes on 7 years worth of activity. And really, for this contractor at the time, this was a very small part of their business. I think in
Mm.
most years it was less than 2% of their annual revenue. So we're not talking huge dollars here, but still a big time commitment really from them, more
Absolutely.
than a dollars and cents commitment. There was just a lot of time and effort that went into this process to go back and determine the liability. And then, of course, because now the state has the sales and use tax filings on record,
Mhm.
we went back and chose to file income tax returns for those years as well and pay any um, required income tax that was due during those tax years. Again, I think the fees that we charge were probably more than the taxes in most years
Sure.
because
Sure.
it wasn't a big part of their business. But again, it's easy for the state to identify these opportunities and generate a little bit of revenue. And every state is hurting for revenue right now. So states are very aggressive
They're gonna come
on
after it.
these matters.
Now, did the contractor just not realize that they had to do this? That they were crossing state lines and this is a requirement?
Yeah, I think it was just, kind of an ignorance issue and,
Mhm.
maybe a little bit shame on us for not asking that that was something they were doing. Quite frankly, a lot of state filing determinations, it's really a cost benefit issue. And whether it's right or wrong, I will say that businesses will make decisions based on the cost of compliance versus the downside or the risk of not filing.
Mhm.
And so, that's a business decision that business owners will make. We can recommend that they file in states, but ultimately, again, if your exposure is pretty low and the cost of compliance is pretty high, you may roll the dice, and sometimes you're going to get caught.
Yeah, that's a really good, I mean, real life example, of crossing the state lines and what can happen, if not filing properly.
Yeah. Yeah. So I think maybe we could switch gears here and say, well, what if I'm running a business and I don't cross state lines? What if I'm only
Yeah.
operating within a singular business here? I do think there are state and local tax issues that those business owners should be aware of as well. There's this concept of a pass-through entity tax that's
Mhm.
kind of a new thing. I think a lot of business owners have started to become aware of it over the last 2, 3, 4 years. But effectively, what this pass-through entity tax election is an election that's made by either an S corporation or a partnership business to pay the taxes for its owners at the business level. And it's really designed to work around the new itemized deduction cap for
Mhm.
state and local taxes. So, under the Tax Cuts and Jobs Act, individuals were limited to a $10,000 deduction cap for their state income taxes, their property taxes. If you're in a state that has personal property taxes, things like that, your deduction was capped at $10,000. And it's now up to $40,000 under the One Big Beautiful Bill Act. It has expanded that, but I think for a lot of successful small business owners, even a $40,000 limit is going to
Mhm.
prevent them from getting the full deduction on their state income taxes and property taxes, and again, any other state and local taxes you might be paying, especially if
Sure.
you're in a high income or high tax state. Doesn't have to be income tax. Here in Illinois, we have pretty high property taxes. So I have clients that their total deductions between income taxes, property taxes would exceed 40 grand. So this pass-through entity tax election allows your business, again, if it's organized as a S corporation or partnership,
Yeah.
to convert your income tax liability on your business income to a business tax expense from a personal tax expense. So it's
Interesting.
not
Okay.
subject to that cap. In the One Big Beautiful Bill Act actually preserved this. There was a part of that bill early on that was going to effectively make it unlawful for these states to allow this, or make it unlawful for you to convert this individual tax liability to a business tax liability. And that was not part of the final bill. So I think there's real opportunities there to generate additional federal tax deductions, really by checking a box
Mhm.
and cutting the check from a different bank account. So it's not, generally speaking, it's not going to change your total state tax liability. It's just
Mhm.
converting it to a business expense. So your business is going to cut the check rather than you cut the check. And the benefit of it is now you're not limited to that either $10,000 or $40,000 cap.
Okay. And I just want to also put a plug in that I know I said that this is part 3, the final series, but we're actually going to do another recording in a few weeks to go over the act that the Big Beautiful Act and dive a little bit more into that. So we could get into more details on that as well.
Definitely. That will definitely be, that's on the agenda for sure.
Good, good. So then when it comes to this, just again, what should contractors do? Again, ask your tax professional, right, about the election and what you can do to avoid these state and local taxes.
Yeah, absolutely. Have the conversation. Depending on the state that you're operating in, the election may need to be done before the end of the tax year. So here in Illinois, we can make the election on the tax return. So for
Hmm.
2025 tax year, we'll make that election in 2026 when we file the tax return. In other states, you may have to make it before the end of 2025. There may be different cutoff dates in 2025 when you need to make that election. So there is a potentially a time sensitivity issue
Okay.
here as well that you need to be aware of in order to get those benefits.
Good, good. Anything else that you want to address with this strategy before going on to our next one?
Yeah, one other sort of state tax issue that I want to bring up is
Sure.
the nonconformity that most states have with federal tax laws. A big one that I typically see is depreciation.
Mm.
So, like I said, we have the 100% bonus depreciation back in play. That's a federal tax law. Um, Different states may or may not conform to the federal depreciation rules. So you may operate in a state where they follow the federal rules, and they may have
Mhm.
provisions in their law that, regardless of what changes are made at the federal level, they'll follow those. You may be in states where they follow federal law as of a specific date. So as
Oh, interesting.
federal law changes, they would be operating under old law potentially. So it's not uncommon. Again, depreciation is just always a good example because construction typically is a very capital intensive business, and
Yeah.
business owners are aware of the benefits they can get there. But yeah, let's say you wipe out your federal taxable income because you buy a bunch of vehicles or equipment before the end of the year.
Hmm.
That depreciation expense may not be available at the state level. So you may end up having a significant state tax liability
Mm.
despite having no federal tax
Federal.
liability. So it,
Yeah.
it can be a surprise if you're not aware of it. And so yeah, I think that's just one thing I want business owners to be aware of is again, what your income for federal purposes is not necessarily your income for state purposes, and there could be very large swings there. I mean, I had a client um, just back in 2024. They did a cost segregation study on a property that they invested in, had a
Hmm.
lost for federal purposes, had income at the state level and ends up, paying state income taxes. So if you're aware of it, a lot of times I think just being aware of these things and not being caught off guard really kind of eases the pain of it. So that's a big one. There's some others, I think again, kind of going back to our first strategy with like loss limitations.
Yeah.
There's different like NOL limitations that apply at the state level that are, differ from the federal level. So here in Illinois for C corporations, for example, we have a limitation on the state net loss deduction that you can claim. It's just capped at a flat 500,000 right now.
Okay.
So again, for federal purposes, you may be wiping out a good chunk of your income utilizing net operating loss carryovers. But at the state level, again, you may be getting hit with a surprise state tax liability because that limitation is different.
Yeah. It's good to know these. It's definitely good to know these. All right.
Yeah.
I'm ready to move on to our third strategy.
Yeah, let's do it.
Okay. Don't sleep on estate and gift planning. I'm interested to hear this one, Cody.
Yeah, so I think, again, this is kind of a overlooked area for most taxpayers. I think people think of estate planning as for the extremely wealthy. And I think the reason they think that is I believe the current estate exemption is $13.99 million for a single taxpayer and $27.98 million for a married filing joint taxpayer. And I believe, don't quote me on this, the One Big Beautiful Bill Act, I believe, increased that to $15 million for single taxpayers and $30 million for joint taxpayers. So effectively what that means is if you pass away and your net worth is less than those amounts, you're not going to be subject to the federal estate tax. So I think a lot of taxpayers think that this is not an issue for them necessarily. But I think that's, again, I think that's a misconception because there are state level estate taxes that apply. Not every state has an estate tax, and some people call this the death tax. So I try not to. That's a little morbid, and estate tax is the more technical term. But just if anybody out there, thinks of it as the death tax, want to make sure we're all on the same page there. So again, like you could have a much lower net worth and be subject to your state level estate tax. I think in Oregon, the threshold is as low as $1 million.
Oh, goodness. Okay.
And there are many states that are less than 5 million. So again, for a lot of us, that still feels like a pretty sizable amount of net worth. But if you've been running a successful construction company for, 20, 25 years, you have a residence, you may have a vacation property, the value of your business, the value of your investments, life insurance, all of these things factor into that calculation. Like it would not be out of the question for even, small construction businesses for the owners to have a net worth that is exceeding the estate tax level in the state that they reside in.
What if you're located in a state, let's say, with no estate tax?
So I think even if you're in a state with no estate tax, it's still helpful to go through this process because it's going to ensure that, you and your heirs are achieving maximum tax savings and also that whatever your wishes in life are adhered to in death. This is not a process that is exclusive to your CPA. I mean, this is going to be really kind of your whole financial team. You're going to have an attorney involved in this process. Your financial planner is going to be involved in this. So it's, really kind of an opportunity to get the whole team together and, talk about what you want, out of your life and out of your business. So again, even if you're not someone who's going to be subject to any form of estate tax, what do you want to do with your business when you pass away? Yeah. That's going to be a question that's addressed during estate planning. You have various assets. Do you start to transition those assets to family, friends, charitable organizations while you're alive, or do you wait until you pass away and do that, through inheritance? So these are all questions that can be addressed during like an estate planning session or sessions, more likely, just to ensure that, again, that you've built a successful business for yourself, you've generated meaningful wealth. You want to make sure that that is handled appropriately.
So what can contractors do now to reduce their estate?
Yeah, so there's some common strategies out there. Annual gifting is obviously one. That's one that I get a lot of questions on. How much can I gift to any single person in a given tax year without triggering any sort of filing? You can gift really any amount that you want, but you may, if you exceed certain thresholds, have to file a gift tax return. And so again, there's a cost of compliance there and things like that. But right now for 2025, the per recipient threshold is $19,000. So if I wanted to gift, $19,000 to one of my nieces, for example, I could do that. My wife could also gift that same niece $19,000. So now we're up to $38,000, right? Yeah. And then, I could look at my other nieces and my one nephew, and again, I could do 19,000 to each of them. So it's a per recipient, per taxpayer threshold there.
Okay. What about charitable giving? Can you do that?
Yeah, again, that's another common strategy, and there's a lot of different things you can do within charitable giving. Something that excites me that I think is overlooked is gifting of like appreciated assets like stock to the charity. So what this strategy does for you is it allows you to avoid the capital gains tax that would be associated with the sale of that stock. So let's say I have stock that's appreciated in value, and I say, well, I want to give 50 grand to, whatever charity you're invested in. I go out and I sell that stock for 50 grand, and then I cut a check, $50,000 cash to the charity. Well, based on whatever my initial investment in that stock was, I'm going to pay capital gains tax on that, and then I'm going to turn around and get a $50,000 charitable donation for the cash donation. What gifting the stock to the charity does is it avoids the capital gain, but you still get the deduction equal to the fair market value. So very beneficial from an income tax perspective, while also having kind of the additional benefit of reducing assets in your overall estate.
Okay. And then I would say probably another one, establishing trust as well.
Yeah, and that can tie, into charitable giving as well. You can set up different types of trusts for the benefit of charities. You can set up, trust to transfer assets to, again, family, friends, those types of beneficiaries as well. And then there are, a variety of kind of special purpose trusts, is how I would refer to them. So you can set up trusts specifically to shelter life insurance proceeds from your estate. If you, again, have some pretty meaningful life insurance policies that would pay out upon death, you can utilize a trust there to, those proceeds are excluded. One that I think is kind of interesting, I've seen a few clients employ this strategy, is it's called a qualified personal residence trust, or a QPERT. And that allows individuals to transfer, like their primary residence or their vacation residence into a trust, while retaining the right to live in that property for a specified term. You do have to pay rent, of course, then. So you're kind of paying rent on your what's no longer your house, but what was your house. Each of these strategies does come with some nuance and complication, but it can all be effective ways to remove appreciating assets from your estate.
All right. I think that those are really good options for reducing their estate. Anything else you want to elaborate on in this strategy before moving on to our next one?
I want to give one other example that I just thought of. Please, this morning. I think a question that I am asked frequently is, I have this asset. I want to ensure that it goes to my kids. Should I gift it to them while I'm alive, or should I wait until I pass and then they receive it via inheritance, right? And this came up for me in a very personal way last summer. My grandma was diagnosed with cancer, and she ended up passing away last December. But I remember last summer getting lunch with my parents and two uncles and an aunt, and that was something that came up at lunch was, oh, should we have grandma gift the house to my dad and my two uncles? And I jumped in and I said, no, I don't think that makes sense, because what's going to happen, if you receive it through inheritance when she passes away, is that you'll receive a step up in the basis of that asset to the fair market value at the date of death. So if they hadn't done that, if they had gone through with a gifting while grandma was alive, what would happen is my dad and my two uncles would receive a carryover basis. So in this case, my grandpa actually built that house. He was a union carpenter for decades. So he built that house. His basis was incredibly low. It's effectively just the cost of the materials, because he had no labor component there. The land they had acquired before the house was built. So I'm sure, I don't have hard numbers, but I'm sure the basis was incredibly low. So if they had gifted that house to my dad and my uncles, their basis would be equal to what grandpa paid to build it. And then when they turn around to sell it, they're going to have a gain on the spread there. Well, because they received it through inheritance when grandma passed, they get a step up in basis to the fair market value at the date of death. When they turn around to sell that, there's going to be probably no taxable gain, maybe a small taxable gain to the extent that it appreciated between the date of death and the date of sale, which, as long as you're turning around and selling the property relatively quick, there shouldn't be much appreciation there. So again, I don't have hard numbers, but I would guess, it probably saved them 30 to 40 grand in taxes just by making that one decision to wait until grandma passed and handle the property that way.
I mean, and that just doesn't even have to do with contractors. I mean, that's just
that's anybody.
Personal. Exactly.
Yeah. And again, like, grandma didn't have a taxable estate. Grandma didn't have a ton of assets, but just that one, real big asset that she did have, just making a smart decision around that, saved several 5 figures of taxes for my family.
Yeah, no, I appreciate, and that's, again, real life example. So that we can all take away from on that one, because we're all going to experience it through our life.
Sooner, well, they say, 2 things in life are certain, death and taxes. So
that's it.
Yeah, it happens to everybody.
It does. Well, let's wrap up this last one here with our 4th strategy. Preparing for upcoming tax law changes.
Yeah, so if anybody does check out the ebook, you'll notice this chapter is definitely different. It's more around kind of mindset and providing entrepreneurs, business owners with resources and things to consider as far as just staying up to date. When the book came out, we had no idea when the next tax bill was going to be passed, what was included in it. So it was really just kind of to encourage business owners to develop like a proactive mindset, in a mindset of continual learning. Let's not sit on our hands and wait for things to come to us. Let's be proactive business owners and work with our professionals to to develop good tax strategy and to just do some very basic learning. Just listening to this podcast is going to put you ahead of your peers. So just taking small steps. You're in the truck, you're driving to a job site, throw on the podcast for 30 minutes. Maybe you find one takeaway and you can go talk to your professional, and that one takeaway could save you significant money in the grand scheme of things. So yeah, that's really what the chapter is around, is just just encouraging like a mindset shift amongst business owners to make sure that this is just an overall part of their business strategy, and they're not leaving it to the last minute.
Yeah, absolutely. And like I said before, we're going to do another recording that we're going to go more in detail with the One Big Beautiful Act.
Yeah, and maybe just to kind of preview some of the topics, hopefully encourage some people to check out that episode. This is just a real quick rundown of some of the things that we're going to cover in that upcoming episode. We're going to talk about 100% bonus depreciation being reinstated. We're going to talk about the expansion of Section 179 and when you might want to use that as opposed to bonus depreciation. There are rules around research and development expenditure expensing, which again, as we talked about in the previous episode, like construction is an area where there's research and development opportunities, and being able to identify those and potentially pursue an R&D credit could have meaningful tax savings. So we're going to talk about that. Like we talked about in episode 1, specific construction tax accounting methods. There were some changes there. There were some less favorable provisions that were passed in that bill. So a lot of beneficial things, but one not so beneficial thing is the termination of various like green initiatives. So we want to talk about that. No tax on overtime, I think, is getting a lot of headlines, and I think a lot of employers are curious, what does that mean for them from like a reporting perspective. So we'll talk about that. We'll talk about the extension of the qualified business income deduction, that's Section 199A. And then we'll talk about the expansion of the business interest deduction limitations. So if you're a business that has meaningful debt and you're paying significant interest expense, there's opportunities for you to deduct more of that potentially. So and that's really just on the business tax side. There's a whole slew of individual tax provisions as well, going back to the increased itemized deduction cap for state and local taxes. So there's a lot of things we could dive into on the individual side of things as well.
Yeah, maybe we'll separate that out then for individuals and then more on the business side.
Yeah, we could do that.
I look forward to it. I definitely look forward to that recording. So, just takeaways for this, talking taxes, someone can easily get overwhelmed. So what would you say, how to avoid actually being overwhelmed when it comes to taxes?
Yeah, I mean, I think, like I said at the top of the episode, like I don't expect any business owner to know this themselves. Anytime I'm doing kind of a networking event or anything where I'm kind of pitching my business, my number one lead in is everybody needs to file a tax return. Nobody should be filing it themselves. Everybody should be relying on an expert to do that. So find your expert, rely on them. You don't have to go it alone. Even if you're, just getting started, it's kind of a new startup business. The investment in good financial advice is going to pay for itself in the long run. So, this is an area where, I mean, when you get started, you got to have your attorney to help get things set up. I mean, you really need to get your accountant, in line with you from day one so that you can avoid mistakes. We fix a lot of mistakes after the fact, but like I said, if we can get in on the front end, we can do a lot of good and save you a lot of money. I think other things, to do to just kind of avoid feeling overwhelmed by it is listen to a podcast like this, where there's experts coming in and, what you do well. If you're a plumber, plumbing really well. You don't need to know every aspect of running a plumbing business. You can rely on experts. And it's not just for tax and accounting advice. I mean, that's everything. It could be marketing. It could be, again, legal, insurance, et cetera. Assemble your team and you rely on them. I think there's publications out there, like Construction Business Owner. There's going to be different written publications too. If you're not a podcast listener, you kind of a little more old school and like to read. I still like reading books physically. So, there's things like that. And then I think trade associations are great as well. a lot of different trade associations out there are going to have, speakers come in, and they're going to have content in like their newsletter blasts and things like that. So could be ABC, could be Associated General Contractors, could be CFMA, which is Construction Financial Management Association. Just there's tons of resources out there. You just gotta make that little effort to go find them.
And also reading your ebook, Laying the Foundation.
Sure. Yeah, definitely that too. Yeah. Check out the ebook.
Yeah, it's free for download. We'll put it in the notes of this podcast as well. So, and then I just also invite my listeners, right? Schedule your free tax strategy call with Cody, just to kind of go over these things. Again, do this before, after the fact. So, Cody, it's been an absolute pleasure, but I'm excited because we are already set to do another recording in a couple of weeks. So again, thank you so much for your time, and truly do appreciate it.
Well, thank you, Jennifer. I'm excited to come back. I know tax reform is maybe not something that everybody gets excited about, but I'm jazzed to come talk about it. There's a ton of opportunities out there to save people money. And, that's what we want to do. Construction's a tough business. It's even tougher when you're overpaying in taxes. So if there's anything we can do to help small business owners, we want to do that. And I'm looking forward to it.
Awesome. All right. Well, with that, we'll go ahead and we'll end it, and we'll see everybody next time on the Lumberyard.